Good morning. Welcome to She and Finney webinar, an update on PP loans and forgiveness, presented by attorneys Alex Pyle, Colleen Lyons, and Paul Royland. We are required to inform you that this webinar will be recorded and will be posted to our website later today. Also, while the following information may include some general guidance, it is not intended as, nor is it a substitute for legal advice. Lastly, we encourage you to submit questions throughout the program using the Q&A button at the bottom of your screen. The formal program will conclude after 30 minutes. At that point, the speakers will then address some of the submitted questions for the next 10 to 15 minutes. With that, I now welcome attorney Alex Pyle to begin the formal program.
Thank you, Kelly, and thank you all for joining us today for today's webinar on this beautiful spring day. As Kelly mentioned, our topic today is the PPP loan program and loan forgiveness, and in particular focusing on what we've learned and what we've figured out in the recent weeks as guidance has started to come out, and what remains to be learned. It's been almost 2 months now since the CARES Act was enacted, and it's been over a month since the first PPP borrowers received their loan proceeds. So all the borrowers who've been funded to date have been needing to make determinations about how to spend the funds to be consistent with the requirements of the law and to ensure that to the maximum extent possible that they will be able to have their loans forgiven under the PPP loan program. Information about some of the forgiveness requirements has been coming out slowly. Obviously, there was some initial guidance and structure set forth in the text of the CARES Act, and then we've also seen interim final rules come out from the SBA and the Treasury. We've seen frequently asked questions released on a pretty regular basis over the last month or so from the SBA, which have answered some questions, some of the very, very specific points that have been helpful. And then finally, as of last Friday, the SBA did release the form of loan forgiveness application, including instructions for completing it, which have illuminated a number of other points and given us a bit of a sense of how some of these calculations are going to be done. Just note that there's still a number of things we don't know. We do expect there's going to be further regulations coming out from SBA and the Treasury, and that they're likely to continue to be FAQs released over the course of the coming weeks that will address additional questions that have not yet been answered. There's also in the background the potential for legislative changes that have been under discussion in Washington, and those could also, of course, change the playing field for us as well. If I could have the next slide, please. So one issue that has been getting quite a bit of attention over the last couple of weeks, certainly, has been the borrower certification requirements, and in particular, the certification regarding the necessity of the loan. When the SBA released FAQs 31 and 37, they introduced a standard that had not been clear to many of us before that, indicating that borrowers should consider their ability to access other sources of liquidity that might be sufficient to support their operations in a manner not significantly detrimental to their business as part of their determination of whether they did in fact have a need for the PPP loan. Then following that, the SBA also announced that they would be reviewing all loans in excess of $2 million and perhaps other loans as well. So those FAQs did raise a number of concerns and questions from parties that have needed some clarification, and there was some clarification that came out ultimately early last week in the form of FAQ 46, which have given some comfort to many borrowers by indicating that any borrower of less than $2 million of funds, and that's consolidated with any affiliated borrowers. So if you have multiple loans within a corporate group, those will all be added up. And if you're less than $2 million, it's going to be presumed that you made the certification regarding necessity of the loan in good faith, and it really won't be further reviewed. And for loans greater than $2 million, the SBA has indicated that even if they do determine that there was a lack of necessity or lack of basis for claiming necessity for the loan, that they would at that point permit a borrower to repay the PPP loan, and they would not pursue administrative enforcement or referrals to other agencies if the loan is repaid at that time. So I think those together have given borrowers some significant comfort on the necessity certification and added some certainty to those issues. I would remind everyone that that in addition to the necessity certification, which is certainly the one that's gotten the most attention recently, there are a number of other certifications that are included in the original PPP loan application, as well as certifications contained in the application for loan forgiveness, which all will need to be reviewed and considered to ensure that that you're fully in compliance with the requirements and able to obtain the forgiveness as anticipated. With that, I'll turn it over to Colleen Lyons to address our next topic.
Thanks, Alex, and thanks everyone for joining us today. As Alex mentioned, the original draft of the initial draft of the loan forgiveness application form and instructions were released late on Friday evening. And while they're not exhaustive, they do at least start to provide us with some clarification and some other helpful information on how the loan forgiveness process is going to go. For purposes of this rest of the presentation, what we're hoping to do is highlight what we saw as the most significant takeaways from the new guidance, and also just provide kind of a high-level overview of how the forgiveness calculation is going to work. So the first new item was the idea of this alternative payroll covered period. I think everybody knows originally the idea was that costs would be eligible for forgiveness if they were incurred during the covered period, which was the 8 weeks that was going to begin from the date the PPP loan funds were dispersed to a borrower. Now the instructions indicate, and I think this was something that the AICPA had lobbied for, that to allow borrowers to have an alternative payroll covered period to align with its payroll cycle, so that if you have a payroll cycle that's biweekly or more frequent, a borrower can elect this. And if you do, what will happen is for at least for payroll purposes, the forgiveness period will start on the first day of the first pay period following the disbursement of the PPP funds. Now, if you do elect to use this alternative payroll covered period, you're going to have to use that consistently throughout, and it primarily affects the payroll computations. And in the application itself, wherever it will say covered period or the alternative payroll covered period, you have to use the alternative payroll covered period if you make the election. It is important to note, though, that to determine eligible non-payroll costs, you're still going to be using the original covered period, so the 8 weeks from the date the funds were originally dispersed. Next slide. So the next area where there appears to be some clarification is around the CARES Act requirement that only costs incurred and payments made within the covered period would be forgiven. That standard had created a lot of confusion. There was questions, does that mean that the cost has to be both incurred and paid in order to be forgivable? And when the instructions came out, there are now some helpful definitions around this that I think suggest that they won't have to be both paid and incurred. So with respect to payroll costs, they indicate that payroll costs are considered paid on the date that paychecks are distributed or when the ACH credit transaction's initiated. With respect to payroll costs, they're deemed to be incurred on the day that each employee's pay is earned. So it's on a pay day by pay, work day by work day basis. And then with respect to payroll costs, they provide that payroll costs that are incurred, so an employee works, but then they're not paid until a payroll period that falls outside of the covered period, that those are going to be eligible for forgiveness as long as they're paid within the next regular payroll date. And then for non-payroll costs, similar concept, non-payroll costs can be paid during the covered period, or if they're incurred during the covered period, but then they're paid on the next regular billing date, even if that billing date's outside of the covered period, that you are going to be able to have that be, for at least the portion that was incurred during the covered period will be forgivable. So if you get your electric bill 5 days after the covered period ends, that's still going to be covered and eligible forgivable cost. So we do expect that there's going to be some additional guidance on this point to kind of get the bounds of how far back or how far forward you can go on some of these. But at the very least, it seems clear that some eligible costs that are incurred prior to the loan disbursement date and paid during the disbursement date will be forgivable, and the converse will also be true. Next slide. So the crux, obviously, of the application is the loan forgiveness calculation. And before going into any more detail on sort of the individual component parts of the calculation, we thought it would be helpful for you to be able to at least see in summary form how the pieces are expected to fit together. And it's kind of a three-step process. The first step is going to be to accumulate the information that you need to determine the eligible payroll and non-payroll costs. So that's up in lines 1 through 4. And Paul's going to be discussing those elements next. The second step of the process is to determine if there are any adjustments that are necessary. And there are two primary adjustments. One is for salary and hourly wage reductions, which again, Paul will speak about in just a little bit. And then the other is for if there are changes, reductions in full-time equivalency. And I'm going to talk about that a little bit later. So once you have the basic elements of the cost together and the adjustment, then you're able to determine what the forgiveness amount will be. And the form provides that it's going to be the smallest of three possibilities. So the first possibility would be, would you just take the payroll and non-payroll costs, reduce them for any adjustments? That's option 1. The second option is the original principal amount of your PPP loan. So if it turns out that you have payroll costs and non-payroll costs, eligible costs that are more than the PPP loan amount, then you're going to be, you can't have more than the PPP loan amount forgiven. And then the last potential item is around the concept that payroll costs had to constitute 75% of the amount that's forgiven. And the way this is captured in the calculation form is that what you need to do is to take the payroll costs that are in line 1 and divide that by 0.75. And so if that turns out to be the smallest number of those three numbers, then that's going to be your forgiveness amount. I know that's pretty quick, and obviously the application form itself has supporting schedules but we thought it would be helpful at least to have an overview. Then I'm going to now turn this over to Paul so he can sort of discuss the elements of the payroll and non-payroll costs.
Thanks, Colleen. Hi, everyone. I'm Paul Royal, and I'm a member of the firm's corporate group. I'll begin today by talking about what we've learned about the calculation of costs from the forgiveness application. We've received largely confirmatory guidance on elements of payroll costs. First among the payroll costs, of course, is cash compensation, which will include severance pay, vacation pay, and any paid leave, with the exclusion of leave that is provided under the Families First Coronavirus Response Act. We know that cash compensation is capped at $15,835 per employee, which of course is representative of the maximum salary permissible under the Paycheck Protection Program of $100,000 prorated over an 8-week period. We also know that no amounts paid to 1099 contractors can be included in the amount of cash compensation. We know that the second element of payroll costs is, of course, health insurance. We know that employer payments towards employees' health insurance premiums and coverages are an includable element. We've had several questions about the treatment of dental, life, or disability insurance premiums. Unfortunately, we do not have specific guidance on those points at this time. Thirdly, we know that contributions by an employer to employee retirement accounts are an eligible element of payroll costs. And finally, we have taxes, specifically taxes that are assessed on employee compensation and paid by the employer are eligible as payroll costs. Of course, this does not include taxes that an employer simply withholds on behalf of an employee. Now, some of the questions that we've seen concerning the calculation of payroll costs are, how would a 1099 contractor, an owner, or someone who's self-employed calculate their cash compensation for purposes of the forgiveness application? The answer to this is fairly straightforward. Those individuals would simply need to look to their 2019 tax return at Schedule C and specifically line 31. That figure should then be prorated across an 8-week period, and that will give you your amount. Now, that figure is still going to be subject to a cap of the $15,835. Another question we've received is, can an employer pay employee bonuses and have those counted as eligible payroll costs? Although we don't have specific guidance on that point at this time, we would be very uncomfortable doing so by virtue of the fact that all borrowers were required to certify as to need and a lack of access to liquidity or other capital when taking out the Paycheck Protection Program funds. Making any sort of discretionary bonus payments would seem to be inconsistent, if not incompatible, with those certifications. If this is a scenario in which bonus payments are mandatory or have otherwise been contracted for, it may be a different scenario, but we don't have specific guidance on that point, so we would urge caution. We've also been asked whether or not an employer can offer wage increases to their employees and have those counted as eligible payroll costs. We feel that this would probably be okay, but the employer should be prepared to justify the wage increase based on the circumstances. So, to the extent you have employees who are out in the public, perhaps a delivery driver who have an increased chance of exposure, or there are other circumstances that are requiring you to pay your employees more to get them back to work, we think that would be justified. We would not advise simply offering wage increases with no justification just to spend the maximum amount of PPP funds. Finally, with respect to the calculation of payroll costs, a reminder to all employers and borrowers, to the extent that you are relying on your payroll service provider or your bank for this information, please be certain to verify it, because ultimately you are the person who is responsible for certifying to the accuracy. Next slide, please. The other element of costs are non-payroll costs. Now, these generally fall into 3 buckets. You have your interest on mortgage payments or other debt instruments, you have rental payments, and you have utility payments. Now, all of these costs, in order to be eligible, must have been in existence prior to February 15th of this year. Where we've received some new guidance under the forgiveness application has to do with personal property. Specifically, interest on personal property loans or lease payments on personal property is now considered a non-payroll expense that is eligible for forgiveness. So, to the extent that you are a business that financed vehicles or heavy equipment, interest payments on those debt obligations would be eligible for forgiveness. Or if you're a company that leases copiers or servers or other pieces of equipment, those lease payments would now be eligible for forgiveness. We've had a question come in on whether or not interest on debt that is secured by personal property that has been pledged as collateral but was not pledged in connection with the initial purchase of that collateral can still be eligible for forgiveness. We have no specific guidance at this time, either permitting that or forbidding that. Another element of the new guidance under the forgiveness application, which Colleen alluded to earlier, is an expanded period for which interest paid on qualified debt is calculated. As you'll recall, under the initial guidance, it appeared to be a fairly tight 8-week window in which all costs had to have been incurred. It now appears that interest that is in arrears and then paid within the covered period, in addition to interest that is incurred during the covered period and paid after the covered period, is eligible for forgiveness. Now, we've had, with respect to utilities, there has been a little bit of new guidance. We have our expected utilities such as gas, electric, water, phone, and internet. What's new is the addition of transportation. So to the extent that you are an employer who has drivers on the road or fleet vehicles, we believe that gas and other tax deductible expenses will fall under this utility umbrella and be eligible for forgiveness. We've received a question about how oil would be treated. We think it would be a defensible position to include oil as a utility if the borrower were to look back at its 2019 usage and prorate the figure based upon that. We would not recommend trying to lump an entire oil fill-up into the covered period. We've had some questions from 1099 contractors about how they can calculate their eligible non-payroll expenses. For that, they should make reference to their 2019 tax return in Schedule C. Any eligible expenses that they either took or were eligible to take can be included under the non-payroll costs umbrella. Next slide, please. So now that we've discussed some of the new guidance on the calculation of the eligible payroll and non-payroll costs, we should take a look at the adjustments to these costs. As we know, any reduction in headcount or salary can result in a reduction in the amount of the PPP loan that is ultimately forgiven. I will focus on salary at this time. We know that a 25% or more reduction in wages or salary of an employee in the covered period or the alternative covered period as compared to the first quarter of this year will result in a reduction of the loan that is the PPP loan that is ultimately forgiven. Now, there is a safe harbor available for employers who restore the impacted employees' wages or salary to their February 15th level by June 30th. The forgiveness application provides a step-by-step calculation that we would recommend any borrowers who intend to take advantage of this safe harbor consult. Now, to the extent that the safe harbor isn't available and there is going to be a reduction in the amount of the PPP loan that is ultimately forgiven, I'd like to point out the reduction is not made on a dollar-for-dollar basis. So, by way of example, if an employer had an employee whose wages were reduced by $15,000, that does not mean that the ultimate amount of forgiveness will also be reduced by $15,000. Instead, that amount will be prorated over a 52-week period. Finally, the calculation of salary reduction is made on a per employee basis. This means that there will be no penalty to the employer if the aggregate payroll is reduced because employees didn't return to work or otherwise were not brought back. However, this can impact headcount, and for that, I will turn it over to Colleen.
Thanks, Paul. And as Paul points out, there is also an adjustment that can be made for changes to full-time equivalency or FTEs. The original guidance that had come from under the CARES Act did not have a definition of full-time equivalent. And there was some thought that maybe what they would defer to the Affordable Care Act standard, the 30-hour full-time, 30-hour employee. But when this form was released, the instructions make it pretty clear that they're going to go a little different path. And so full-time equivalency, or FTEs, are going to be determined one of two ways. The first option is that you can determine the average number of hours for each of your employees and divide that by 40, and then round that to the nearest tenth. The maximum FTE each employee can be is 1. So even if you work 60 hours, you're just 1 FTE. If you work 20 hours, then you would be 0.5. There's an alternative, what they called a simplified method. And under that method, if you elect it, what you would do is every employee who works 40 hours or more would be assigned 1 FTE. And any employee who worked less than 40 hours would be assigned a half an FTE. Whichever method you choose, you have to use the same method. The FTE computations have to be done consistently for all purposes of the computation. Next slide. So then in order to figure out the reduction for the changes, you need to have a base period. And this didn't really change the base period options for non-seasonal employers. And so the reference period can be selected by the borrower. It's either going to be the period February 15th, 2019 to June 30th, or alternatively, it can be the first 2 months of this year. In the case of a seasonal employer, this was a bit of a clarification. A seasonal employer can select either of option 1 or 2, but they also have the option of they can select a consecutive 12-week period between May 1st, 2019 and September 15th, 2019. Now, one thing that had been previewed, there had been a frequently asked question of FAQ 40 that had discussed the situation where you have a laid off employee who refuses reemployment after a good faith written offer of employment. And this was coming up because the unemployment benefits and compensation now are so high that it may be difficult to entice workers to come back and when they can actually be paid almost as much or more accepting unemployment. And so the frequently asked question response indicated that you wouldn't be penalized in the FTE portion of the calculation for people who, after being asked, decided that they didn't want to come back. And that does seem to have been carried through in the instructions to the form. It's been expanded a little bit more as well to pick up people who were employees who were fired for cause, any employee who voluntarily resigned, or an employee who voluntarily requested and received a reduction of hours. And it looks like what's going to happen is that the borrower is going to get FTE credit for these employees who have not returned unless the employer gets a replacement, in which case the replacement employee will count for the FTE. Next slide. So once you have all of this information, you're able to figure out what the form refers to as the FTE reduction quotient. And that's just a fraction. The numerator is the average weekly FTEs during the covered period, or your alternative covered period, divided by the average weekly FTEs during the whatever reference period the borrower has selected. If that FTE reduction quotient turns out to be less than 1, it needs to be multiplied by the maximum amount that was otherwise eligible for forgiveness. And that, if you do that, you will arrive at the reduced permitted forgiveness amount. Next slide. And as with the salary and wage reduction, there is a safe harbor that exempts a borrower from having to take into account the reduction based on the FTE reduction quotient. And it's going to be exempted if both of the following conditions are met. So the borrower has to have reduced its FTE employee levels in the period beginning February 15th through April 26th. and then they have to be restored no later than June 30, 2020, to the level that it was at February 15th, 2020. So with that, I'm going to pass it back to Paul to discuss some of the documentation requirements.
Thanks, Colleen. Since I know that we're coming up on time here and there are a lot of questions, I'm going to try and run through this fairly quickly. There are a multitude of documents that any borrower should maintain, and many that will be required to be submitted with a forgiveness application. For payroll costs, this is all fairly straightforward. You'll need your bank statements, tax forms, any tax filings, canceled checks, and account statements to verify and confirm payments made for covered payroll costs. For 1099 contractors, they've asked what do they need to substantiate their payroll. They have already submitted their Schedule C from their 2019 tax return with their application, so they do not need to provide anything further. For the non-payroll costs, be sure to have documentations ready to prove that either the obligations were in existence prior to February 15th. So any sort of lease documents, if it's a mortgage obligation, the note, including the amortization schedule, and for utilities, you'd want to be able to show your prior account statements. And to verify that the payments have actually been made, of course, just canceled checks or your account statements. Where it's not quite as obvious, but very important, is when we're dealing with employees, FTEs, for whom are no longer with an employer, but for whom the employer is seeking credit. For any employees who have been offered reemployment, but have refused that reemployment, be certain to present that employee with a written offer letter, and to the extent possible, have them decline it in writing. For employees who are quitting, if it's not customary that they would submit a written resignation, we would certainly encourage it at this time. And for any employee requesting a reduction in hours, make sure that they submit that in writing and keep those all in a paper file. Finally, and this is more of a general note, all records related to the PPP forgiveness application, as well as the initial application, and all documents that could be used to support your needs certifications need to be maintained for 6 years from the date of forgiveness or repayment. And with that, I will turn it over to Alex for some concluding comments.
Great, thank you, Paul. Just a final note here, and then we'll get to some of the questions that have been coming in. As I noted at the beginning, there is going to be some additional guidance we expect to see coming out, additional FAQs, additional regulations, as well as potential legislative initiatives, which have, for example, suggested that there's been suggestions by some in Congress and others that there should be a longer period than 8 weeks, at least for certain types of businesses, that will be allowed to be applied toward the PPP loan forgiveness. Those kinds of possibilities are certainly out there, although unfortunately, if you've got your PPP money and you are needing to be spending it, you really have to assume that we're living under the 8-week rule now, because that's all we have today. But certainly going to be important for everybody to continue to monitor developments that have been coming in and that will continue to come in, and we will do our best to keep you updated with client alerts and further webinars as new information becomes available. So with that, if I could have the next slide. We'd like to try to address some of the questions that have come in. We've gotten a lot of great questions during the course of the webinar, and so let's see if we can speak to some of those in the time we have. So one question that came up is whether contributions to retirement plans can be included as eligible payroll expenses, 401ks or things like that.
Yes, Alex, those are generally considered to be an eligible element of your payroll costs. Another
question that came up was about the the sort of the mechanics of the forgiveness process. Will the bank actually send you your PPP forgiveness application, and what's the deadline for submitting that application?
As with the loan application itself, I think that the way it's contemplated, the SBA is going to have its standard form. The lenders will be allowed to put the form onto their system so that the information can be collected electronically. But it will probably contain, be very similar to the existing form. As soon as your covered period is completed, you can start to accumulate the information and then submit the forgiveness applications. Although I am aware that there are some lenders who have are delaying. I think there's sort of like limitations that you can't submit your application until like July 1st. I don't know whether they wanted time for the regulations, but I am aware that there are some lenders who have set timeframes for when the forgiveness applications will be submitted.
Great. Another that came up was around the concept of expenses being paid and incurred, and does that imply that you might be able to, for example, cover 9 weeks of payroll expenses if you incur a week at the beginning and then pay a final week at the end after the 8-week period for the final week. How does that work? Are we really just capped at the 8 weeks, or is there potential to count in a 9th week or some additional utility costs if some are incurred and or paid?
Yeah, I think it's not 100% clear, and I do expect there are going to be some regulations around it. It does sound like, if you pay a payroll that was incurred before the start of the covered period, it seems from the instructions to the form that that's going to be permitted. But I think the other thing, so potentially it's 9 weeks. As I said, I do think there's going to be some limitations, and you will, for any of the employees that are at the $100,000 level, you will still be limited by I don't recall the amount, but there's a 15,000 number. So even if it's 9 weeks of payroll, you're still going to be limited to that 15,000, which represents the 8 weeks. The 8 weeks.
Yeah. Great. Another question: What if for the purposes of calculating lease expenses, if you have a lease that's that expired after the February 15th date, and then a new lease was entered into with the same landlord, but so it's not you're paying now rent on a new lease that wasn't in existence on that prior date, but it's still with the same landlord. Is that eligible, or do you miss out?
It seems like a pretty defensible position that it would be eligible, since it's a continuing relationship, but there's not specific guidance on that point.
Yeah, that makes sense. Another interesting question that came up since internet expenses are part of the utility costs. What if an employer is reimbursing employees for their home internet costs during this period of time? Can that then be treated as a utility cost, which could be rolled in? Thoughts on that one?
I think I would ask if that had been a practice that was in place prior to February 15th of this year. But again, I don't know. Colleen, do you have any thoughts on that?
Yeah, I don't know. I mean, I guess there's probably 2 ways of looking at it. One would be whether or not it was a utility, a non-payroll cost, and fell into the utilities bucket, or if somehow it might otherwise be some kind of compensation to the employee, and maybe as it could be a potential payroll cost that you're reimbursing them. So I don't know. I would think either of those options, and it might be a possibility.
Yeah. Okay. That makes sense. what about rent paid to a related party? What if a business owner or an affiliated business owner also owns the property in which the business is conducted? Does that create any problems for treating that as a non-payroll expense?
I think at some point the regulations are going to address that. It's a pretty common question and a pretty common situation. Right now, there's nothing that seems to prohibit it. So as long as I think you have a written lease agreement and the lease rate is at a fair market value rental, that it's a defensible position to sort of include that cost and absent some guidance to the contrary.
Yeah, pretty consistent with your past practice for paying rent. So another question that was raised was whether an employer that doesn't require employees to work a full 40 hours a week, so you have a 37.5 hour week for your employees as your standard, does that mean you're going to essentially, be treated as being not having each person qualify as a full FTE, but be a 98% FTE or whatever the number would be?
I saw that. That's a good question. Although I think that if you take the person that's the 37.5 hours and do it 37.5 by 40 and the tenths, it's going to be the numerator and the denominator are going to have the same value. So it may not make that much of a difference, but you probably would have to go and use the version of it that does the tenths. Or maybe you make everybody a half. Anyway, I do think it will impact both the numerator and the denominator, so it may not really have an effect on the reduction piece of it. But it's a lot of math.
What about employees who are out on workers' comp or disability? How are they treated in the FTE calculation?
That was not addressed in the instructions, but it would seem, given their willingness to allow sort of those other carve-outs for people who have been terminated for cause or people who voluntarily are out, it seems that it would be within the spirit of what they're talking about to include that person's FTEs, so that you wouldn't end up with an adjustment for that in that circumstance.
Mm-hmm. Yeah. Another question, and we had a lot of them, so really appreciate all the great questions we've had today. Another question is there any restriction on salary or wage reductions or reductions in FTEs after you've gotten through your 8-week window period? Could employers and might employers at that point then lay people off or reduce salaries after they got to the end of the qualifying period?
There's been nothing in the guidance that I've seen. Again, I think that's something that people suspect is going to be reflected in the regulations when they're issued. But no, I mean, right now it's just the 8-week period, and after the 8-week period, unless it ends up being extended, the employer is free to do what they want.
Yeah. So another question is, how do people deal with the somewhat changing landscape here? Some people apply for the loan based on the final interim rules that came out in early April, and now have found things shifting a little bit since then. And is there any relief for them in terms of their forgiveness? Based on what was known at that point versus what's changed since then. I'm afraid the answer is no on that one. Ultimately you may not get your full loan amount forgiven as a result of some of these changes based on what you expected. Hopefully you'll be able to get most of it forgiven, and the differences will not be enormous, and you'll be able to just return any amount that ends up not qualifying. I don't know, Colleen, do you have any other thoughts on that?
No, I mean, I think you're right. I mean, the landscape is changing and it continues to change. But I don't think at this point, there's too much. I mean, at the end of the period, if the money's been set aside and you haven't been able to spend it for forgivable costs, it certainly can just be repaid. And then you won't have the debt obligation anymore, and you'll have, whatever you can have for forgiveness. So that's one approach to it.
Yeah. Which is a pretty favorable, 1% interest rate for 2 years. So you do have some time and pretty favorable terms to pay off anything that doesn't end up qualifying. I'm just going to address one more question here. We haven't been able to get to all of them today, but do want to be respectful of people's time. So final question, whether contributions for workers' comp insurance are treated as a payroll cost.
Yeah, that's an open question. At this point, we have taken the position that because it has not been explicitly identified as being included, that it is not. But we do expect some further guidance on that.
Great. Well, thank you, Paul and Colleen. Thank you all of you for joining us today for this webinar. Really appreciate the attendance and the great questions. And I hope you all stay well and healthy. And look forward to continuing to connect with you in the future.